Hi and welcome back. In today's video, we're going to be going over the federal student loan repayment plan called SAVE, so let's get started. Please note that all this information is just a summary of different articles that are found from the student aid website, so studentaid.gov. And as always, please double check by calling your federal loan service provider to confirm the information I'm giving you because it is based off of their websites. What is the SAVE repayment plan? Well, SAVE is actually an acronym and it stands for Saving on a Valuable Education, and it is an income-driven repayment plan, also known as an IDR. It is a repayment option for those who have federal student loans that are covered or serviced by federal student loan servicers. So it is not something that is available for those who took out student loans privately through a bank or a third party that is not associated with the government. Now, it is touted as a good option for a lot of borrowers because the amount of money that you are paying towards your student loans is going to be based off of your family size as well as what is called your discretionary income. For many, they find that they actually have a lower monthly payment by using the SAVE plan than instead of using the standard repayment plan or the other income-based plans that are available as a repayment option. In some cases, you actually can qualify for a $0 monthly payment. Another benefit to utilizing the SAVE repayment is that the government does cover your interest if your monthly payment is not enough to cover your interest. So what this means is that for sure, if you are on the SAVE repayment plan, your balance will not go up because of interest, because no matter what, your interest is being covered, even if you have a $0 monthly payment. Another benefit to the SAVE plan is that if you are married but filed separately, then you no longer have to count that spouse's income when you are setting up this plan, as well as the fact that you do not need then your spouse to sign off of this type of application. Starting in July of 2024, there's actually going to be a change to the SAVE plan. So payments that are for undergraduate loans, instead of being capped at 10%, will be capped at 5%, resulting in a lower monthly payment. With the SAVE plan, there's also student loan forgiveness, and I'll be talking about that later in the video. So what is an IDR? Once again, an IDR stands for income-driven repayment, and it is a type of student loan repayment that is based off of your family size as well as your income. The idea behind this is that by adjusting for your income and your family size, the payments should be more affordable. How is SAVE different from the other IDR plans? So other than the SAVE plan, there is the Pay-As-You-Earn plan, or the PAYE plan, and then there's also the income-based repayment plan. Now, there used to be the revised Pay-As-You-Earned, or the REPAY. That one is no longer going to be offered. In fact, the SAVE actually replaces it. So aside from the interest waiver being one difference between the SAVE and those other two plans, is the fact that it changes the amount that is protected against the poverty line. So for both the pay and the income-based repayment, it is capped at 150%, but with the SAVE plan, it is at 225%. As I mentioned earlier, in July, there is going to be a change in the undergraduate amount. So for undergraduate student loans, it was capped at 10%, and that is true for the IBR, but with the SAVE plan, it is going to be then capped at 5%. So the monthly payments for all these plans are based off of your discretionary income. How the federal government defines discretionary income is by taking your adjusted gross income, so your AGI, which is found on line 11 of your 1040, that's just your normal tax return. And in general, your AGI is a little bit lower than the actual income that you fully claim. But anyways, it is the difference between your AGI and then the amount exemption for the poverty line. So in the case of the pay or for the IBR, it is 150% of the poverty line, but with the SAVE plan, it now protects 225% of the poverty line. So that difference is then considered your discretionary income amount, and then the monthly payment is based off of 10% for graduate loans, 5% for undergraduate loans starting in July, and if you have a mix, then it is a weighted average amongst those two. So to make it easier, I'm going to run an example of how it calculates later on. Does the SAVE plan cover all types of federal student loans? So the answer is no. In fact, I'm going to put on the screen the chart that they have on their website so you can read to see what type of loans qualify and what loans are not. So how are your monthly payments calculated on SAVE? Well, it's a 3-step process. And so I'm warning you right now, I'm going to be putting these steps on the screen and then I will be running an example. So step one is to calculate the protected income amount. In order to do this, you're going to have to go to the HHS Poverty Guidelines, and I'll have the link in the description below. So you're going to find the one that is relevant to you. So there's going to be 3 tables. There's one for the 48 continuous states and Washington, D.C., and then there's a different one if you are in Alaska and a different one if you are in Hawaii. So you want to find the table that is relevant to you, and then you're just going to scroll and look for the one that is relevant to your family size. Then you have to multiply that amount by 2.25, because 2.25 is that 225% converted into a decimal. Step 2 is now you have to figure out your annual discretionary income. In order to do that, you have to take your adjusted gross income, again found on line 11 of your 1040, and then subtract the protected income amount from step 1. Step 3. Before July 2024, this is calculated one way, but after July 2024, it will vary. So I'm going to cover the current way, and then we'll talk about how it changes. So right now, you take the number you got from step 2, and then you times that by 0.10. That's because currently all payments are capped at 10% of your annual discretionary income. Then you're going to divide that by 12 because there's 12 months in a year. After July of 2024, the percent of the annual discretionary income changes depending on what is the amount of your loans. So if you only have undergraduate student loans, instead of being capped at 10%, will be capped at 5%. Your payment will be lower. If your student loan debt is only graduate loans, then it's going to remain at that 10%. So your monthly payment is not going to change. However, if you have a mix of loans, meaning that you have some undergraduate loans and you have some graduate loans, then you're going to have a weighted average between that 5 to 10%. So it could be anywhere from above 5 to below 10. So essentially, either way, it's still going to be lower than your current monthly payments because, again, your undergraduate loans are no longer going to be at that 10%. They're going to be at the 5%. All right, so now that we went over the 3 steps, I thought it'd be easy if I put an example. So what I'm going to do is I'm going to have 3 different people. So there's going to be a person with a family of 1, then there's going to be a family of 2, and then there's going to be a family of 4. To keep it simple, I'm also going to make it where they all have an AGI, which is the adjusted gross income of $55,000, and there's going to be no difference in their student loans because they only have graduate loans, so it's going to be capped at the 10%. So again, amongst the 3 that we're going to be calculating the estimated monthly payment, the only difference is going to be in family size, and that's going to show us how the poverty line is going to change what the monthly payment is going to be. So for those of you who are visual, I would tune in to watching the video because I will have a graphic on the screen that breaks it down. All right, so once again, everybody has the AGI of 55,000. So for a family size of 1, when we look at the table, you're going to see that for a family size of 1, the poverty amount is going to be $15,060. Now, to figure out the protected income amount, we have to take that poverty amount and then times that by 2.25 because, again, the SAVE plan protects 225% of poverty. $15,060 times 2.25 is going to come out to $33,885. So that means that their annual discretionary income, which is the $55,000 minus the $33,885, is going to be $21,115. So to figure out the estimated payment, we're going to take the $21,115 times that by 0.10 because that's 10% converted into a decimal, and that's going to come out to $2,111.50. And then we take that and divide it by 12 to figure out the estimated monthly payment, and it comes out to $175.96. Now, for family size 2, the poverty amount is $20,440. To figure out the protective income amount, we times that by 2.25 and we get $45,990. So if we subtract that from $55,000, we are left over with $9,010. $9,010 times 0.10 is going to equal $901. Divide that by 12 and the monthly payment is going to be about $75.08. Now we're going to look at it for a family size of 4. The poverty amount is $31,200 times that by 2.25 and we get $70,200. So if we subtract the protected income amount by the AGI, we actually come out into a negative $15,200. As per this calculation, this family has no discretionary income, so the payment will be 0. Just in case, we're going to take the annual discretionary income times 0.10, so 0 times 0.10, and then divide that by 12, and they come out with a monthly payment of 0. So I hope that example was helpful. It should illustrate to you that a larger family size is going to get more benefits dependent on the amount of money that is claimed as the AGI. It should also show you that for some families, it is totally possible to get a 0 monthly payment. Last year, my family qualified, and we're a family of 4. So last year we qualified for a 0 monthly payment. And now that we did our taxes, our AGI now pushes us above that. So we will have a monthly payment going forward once we have to recertify. How often does the poverty line change? So the poverty line changes on an annual basis. So every year it tends to go up a little bit to account for inflation. How do you apply for the SAVE plan? You can apply online by going to studentaid.gov/IDR, and there's an online application. It takes roughly about 10 minutes. You put in your information and you have the ability there to either manually enter your tax information or grant them permission to contact the IRS and pull your tax information for you. That is also where you can recertify online. The other option is calling your student loan service provider. So you call them up and say that you were interested in applying for an income-driven repayment plan, or just in general that you want to see your options, and then they will on their end manually set it up to see if they can certify you and give you a better monthly payment. How long does it take for the application to be processed? So according to the website, it can take up to a couple of weeks. But they also have a statement that if your payment is due within 10 days and you do not get an answer within those 10 days, then it is possible to contact your loan provider to get a forbearance while it is being processed. So I want you to note that if you do take this forbearance, it means that your payment is not going to be due, but the interest is still going to continue to accrue. So if you don't not qualify, and even if you do qualify, interest will accrue during that forbearance period until you have the IDR plan approved. What happens to that interest? Well, that interest then gets applied to your balance as to what you owe. How often do you have to recertify? So recertification is done on a yearly basis. You can do this over the phone by contacting your student loan provider, but if you did the application for your IDR plan online and you gave consent for them to contact the IRS and get your tax information, then it's supposed to automatically do it for you. So how does that work? Well, your tax form has all the information it needs. It has your AGI, it has the number of dependents you have, so therefore they should be able to figure out your family size, and they also have your marital status. So if you are married filed jointly, then they know that they are counting both of your incomes. If you are married but filed separately, then they know that they are only counting your own income. What happens if you have a life change, like you have another kid or you experience a job loss? So the best thing to do is contact your student loan provider, because then they can do an automatic recalculation for you based off of the new information, and that will potentially change your student loan payments. What if my spouse also has federal student loans? All right, so this answer is based off an article that was written before the SAVE plan went out. So again, I'm not 100% sure on this. Please contact your student loan provider. But based on the article called 4 Things You Should Know About Marriage and Student Loans, is that it states, and I have the quote on the screen, that it'll be prorated between the two of you. So if the cap percentage is 10% of your discretionary income, and let's say your discretionary income on a monthly basis is $600, but you have 60% of the student loan total, and then your spouse has 40%, then that $600 is going to be split. 60% of that $600 is going to be your monthly payments, and then 40% of that $600 is going to be your spouse's monthly payment. So in that case, your monthly payment would be $360, and then your spouse's would be $240, because $360 is 60% of $600, and then $240 is 40% of $600, and then $360 plus $240 equals $600. Does that make sense? So again, that was based off an article that was written before the SAVE plan came out. I believe it to be true that they are going to continue that prorating, because it is how they handle the other IDR plans. But again, I am not sure, because I didn't see anything mentioned about this on their website. So contact your student loan provider. Does the SAVE plan offer student loan forgiveness? Yes, the SAVE plan does offer student loan forgiveness, and it is different than the other IDR plans, but it is kind of done on a graduated way. So I want to quickly touch base about that. If you have undergraduate student loans under $12,000, your original taking out, it was under $12,000, then your repayment cap is 10 years. So if you make timely payments for 10 years on the plan and you still don't pay off that $12,000, the rest of it will will be forgiven. Now, every $1,000 borrowed past that, $12,000 for undergraduate, adds another year to the repayment. So let's say you borrowed anywhere between $12,001 and $13,000. Then you're going to have to make payments for 11 years. Let's say you took out $14,500 originally for your undergraduate. Well, then it's going to take you 13 years. Now, according to the website, they have a max cap for undergraduate loans as 20 years. For graduate loans, then you are capped at 25 years. So you have to be making consistent payments for the full 25 years, and if there is still a remainder, then it will be forgiven. So what payments count for the student loan forgiveness? So payments that count are any that you make while you are on an IDR plan, or if you made payments while on the standard loan repayment plan. So if you have a save plan that offers you a 0 monthly payment, then yes, that 0 monthly payment will count towards the valid payments for either the 10 years, the 25 years, dependent on the mix of student loans that you have. Is student loan forgiveness taxable? So this is a complicated answer right here, and I need you to pay attention. Right now, under the American Rescue Plan Act, student loan forgiveness from IDR plans is not considered a taxable event federally until 2025. So as of right now, until 2025, you can have student loan forgiveness and it will not be considered taxable on a federal level. However, states did not follow suit with that. Some states do have it as a taxable event, so if you get your student loan forgiveness, it will count as income and then be subject to state income tax. So in order to find out whether or not it is taxable, you need to pay attention to your state's laws around that. And that, ladies and gentlemen, is the basics around the SAVE student loan repayment plan. Shout out to JBC Ill at Will for giving me the idea and posting it as a comment. I hope it answered your questions, and if it didn't, let me know. If you have more questions, let me know, and I'm happy to do another deep dive or give you some more information about it. To those of you who are new tuning into the channel, thanks so much for checking it out. I hope this video brought you some value and answered some of your questions around the topic. If you like personal finance topics broken down and you don't mind also a monthly debt update, then please consider subscribing to this channel, because that's what I do. I try to answer people's questions on personal finance, and then I talk about my own debt journey. So if that interests you, please consider subscribing. Now, for those of you who are not new to the channel and are current subscribers, thank you so much for your continued support. I really appreciate that you guys are tuning in. I love the engagement. As you know, one woman show, so if you are commenting, I am responding, and it also lets me know of future video ideas. So if you have a question, let me know. If you could do me a favor, please like this video, share it with a friend, and if you are on Facebook and you want more contact with me, I did just make a Facebook group, so check out for Debt Tale on Facebook and you should be able to find the group. It's private right now and it will remain private, but hey, we'll be talking about personal finance and being financially transparent, and I hope that's something you're interested in, because it would be cool to have you join us over there. For those of you who do not feel comfortable dropping down a comment, I do also on my website have a contact page where you can also put in your questions on personal finance if you would like me to make a video on that. So please check out debttail.com, then hit the contact page so that way you can write in your question there if you do not feel comfortable putting it in the comments down below. I'm trying to give you guys more options to be able to let me know what you would like to see, and the only way I know is if you can give me some type of message about what you would like to see. So I hope you have a good one, and until the next video, bye!